So what are the topics we have here? We have cost volume profit analysis, risk analysis, investment appraisal. So under connected to cost volume profit analysis, other decision making issues about cost volume profit analysis are limiting factor analysis, make or buy. So these all of them have numerical questions. So let's see how much we can do. I'll just explain the concept to you. Anywhere it is possible for us to look into the numerical questions, we will be doing that. Assuming it is a PPT, I keep pressing that this button. So let's understand what's the meaning of risk. Okay. After that, in the sequence, we have the investment appraisal. Cost volume profit analysis, and then finally investment appraisal. So let's quickly take it up. What is the meaning of risk is when the future values are predicted, expected. At the time of expecting the values for the future, it is also understood that there is a possibility that whatever is expected would not happen. So if it would not happen, what is the variation? So the variation in the expected value is termed to be as risk or uncertainty. But there is a technical difference between risk and uncertainty, that the probability of this variation, if it is known, we call it as risk. If it is not known, we call it as uncertainty. So here the data, the on this slide, what we have is basically about, there is an example given about how much time is taken in a minute to complete a task. The data is collected from various individuals. Around about 20 values are there. So now this 20 values individually, these are values, but if they have to be organized, presented in a visually appealing manner, what is done is this data is grouped. You also know this basics of statistics. So it is grouped into classes or groups, and then the data is collected. Less than 15, the value of less than 15, no one's there. Then 50 to 17, two people are there, so on. So there is a tabulation taken up. After the tabulation, the tabulated data can also be presented on a graph using either a line graph, histogram, etc. So that is what is taken up. And after that, for this data, so when these values are taken, the time taken by 20 people, if it is taken, so the summary of it is the table is prepared, group table is prepared, and presentation, graphically appealing presentation also can be taken up. So that is what we have understood. After that, then when there are so many values, on an average, what's the average value? What if it has to be understood? There are certain measures with which we can find out what is the average. What does it indicate about? What does that mean about average value? It says that what is that value around which most of the values are close to a particular value. So that is taken to be as the average. So we also call it as a centrally located value, measures of central tendency. The tendency that the data lies around a particular value is the average value. So how do we understand that? So that is mathematically calculated, wherein all the values are added up and divided by the number of items gives us mean. Median talks about when the data is arranged in either ascending or descending order. The value which is n plus 1 by 2th item. So which means that with the one which is in the middle, the central value. So n plus 1 by 2th item is the median. Mode is the one which repeats more number of times is the mode. Okay. Range talks about what's the least value and what's the highest value. So the highest data value minus the lowest data value forms the value of a set of data. Done. Let's say that in a class of few students, if we are talking about the marks, let's say the marks are considered. So somebody says that the average mark is 70. So what does it indicate? Does it indicate that in a class of 50 students, if we are talking about the average mark is 70, does it mean to say that all 50 of them have scored 70? No. It indicates that most of them have scored a value closer to 70. That is the meaning, that is the indication. So average value indicates that a major part of the group of values are either 70 or closer to 70. So on that note, 70 is the value. But does it mean to say that everybody's value is around 70? No. There might be someone who might have scored only 40. So there is a possibility that there is a value which is far away located, or someone might have scored even 100 also in that particular subject. So we see that, yes, we are seeing that most of them are around 70, but there is also a possibility that values are deviated from the central value. That is, they are dispersed, they are far away from the central value. So such chance also would be there. In that class, there might be somebody who must have scored only 40 marks. So that possibility is also there. So what is that percentage, or what is that chance that somebody's mark is not close to the average mark? So that is what we are looking at. So standard deviation and variation talks about a value which is far away from the central value. These are measures of how far the data points are from the mean. Then that is calculated by way of standard deviation. Standard deviation, see, when we talk about average is calculated as x bar. X bar is equal to sigma x divided by n. So individually under x, there are various variables. So each variable is compared with the x bar. So is it closer to that or is it far away? What is the deviation? Because more or less very close to that 70 should be all the others. So if at all when this is compared, what is the deviation is noted down. Deviation could be positive, deviation could be negative. So just because there is a negative value also and positive value also, to make it in a uniform pattern, what is done is x minus x bar is squared up to just eliminate that negative impact of it. After this is squared up, the sum total of it is taken and divided by the number of items, and then we have the square root calculated because it's already squared up. Therefore, the square root is calculated to eliminate that squaring part of it. So standard deviation is one way in which risk can be calculated. So unsystematic risk is calculated by standard deviation. If it is systematic risk, some other paper you will learn that there are certain other tools also which are available to measure the risk, like beta. Beta is used to calculate systematic risk. For the moment, it is a basic paper, so just understand that if a value which is away from that is the chance that it would be dispersed or deviated. So deviation causes a risk. See, this is a basic example of mark. For example, in an organization, if you are focusing on the average profit, if some value or some um, value of the profit or loss in a year, if it is a loss of some amount, so loss or very low profit or quite far away value of profit is there. So that indicates that there is a chance that they will not have a profit as much as what is average value which is indicated. Let's say average profit is 10,000. average profit is 10,000, they can be assured that on an average each year they would earn 10,000. But there is also a possibility that there may not be a year where there is a profit earned, because some the values in the data set also may have minus 2,000. If we are saying 10,000 average profit, there might be some year where the profit was only minus 2,000. There was a loss of 2,000. So that also is a possibility which can occur again, because it has happened in the past. So that possibility is also there. That deviation is also there. So how do we calculate that deviation? Is by way of calculating standard deviation. Okay. Um, Standard deviation is equal to variance under root of variance. Variance is equal to standard deviation square. Um, this is an example. The data is given, and then mean is calculated. Mean, median, mode, they are calculated. Then how to calculate standard deviation? We find out fx square by sigma uh, minus sigma fx by sigma f whole square. So the deviation is calculated because they squared it up, and then root is calculated. Formula based, just have to substitute in the formula and then find out what is the standard deviation. So if we are taking average to be 100%, deviation percentage is how much? So standard deviation into 100 divided by mean gives us what is the coefficient of variation. Coefficient of variation, if the variation is quite high, risk is also high. If the variation is low, risk is also low. So that is how we interpret. So this is basically about a mathematical example. You also can work it out. Formula based, substitute the formula. In the formula, substitute the values and then arrive at that. The next topic what we have is what is normal distribution. Normal distribution. See, in case of probability distributions, probability, um, theoretically when we study what is probability is the probability of an event is equal to the favorable events divided by the total number of events. So what is the chance of a thing happening can be calculated as, out of all the possibilities, those possibilities which have a possibility to happen. Okay. So we call them as possible events divided by the total events. Done. Then see, experiments which are conducted are not as simple as when a die is rolled, when a coin is tossed, but there are complex situations where the solution has to be calculated. So in such situations where the um, value of n, depending the number of items which are included, it is 30 or more than 30, then we see that there are certain probability distributions at an advanced level which can be used to find out the value of a probability. We have binomial distribution, Poisson distribution, normal distribution. So what is the probability to find out the normal the normal distribution talks about uh, finding out the value of probability by using a normal distribution equation, and then later on referring to the normal distribution table values, plot it on the normal graph, normal curve, and then find out what is the value of probability. What are the steps which are included? See, first we understand what are the features of the normal distribution. Normal distribution, we see that there is a normal curve which is in a bell shape. It is at its peak when it is at its mean. So mean is equal to at the value of mean. Mean is equal to median is equal to mode. At that point, the curve takes a is at its peak. Then the then it falls down. The shape of the curve is symmetrical, which means that if it is divided into two parts, so either side of mean, we see that it is the same shape. Then the curve takes the change in the curve when it is x bar plus 1 standard deviation. So the curve extends from minus infinity to plus infinity. Then the total area which is covered by the normal distribution curve, which has x bar plus 3 sigma, has 97 point some percentage of the area which is covered. How do we have to find out the probability value? It says that the total value of this area extending from minus infinity to plus infinity is equal to 1. Because the curve is symmetrical, on either side the total value is 0.5, because the total area is 1. Probability, the total value is always equal to 1. The probability of all the events added together in any experiment, it would always be equal to 1. Okay, so when, because it is divided into two equal parts, on each side of the division, we see that it is 0.5. Uh, then, if we know the mean and standard deviation, we can use the normal distribution to work out the percentage chance of a value occurring. So, probability can be calculated if at all, if we can, if we have the possibility to know what is the mean and standard deviation, that can be calculated. There is a formula which is given, z is equal to, we see x minus mu by standard deviation. So mu is equal to mean, standard deviation is the deviation from mean. Okay, the variable x minus mean divided by standard deviation gives us the calculated value of z. After the calculated value of z, the calculated value of z is referred to the z table or the normal distribution tables which are provided in statistics book, and then find out what is the value in the table value. So bring that table value and plot it on the normal distribution curve. After it is plotted, then whatever is the feasible region, that feasible region is highlighted, and that becomes the probability of that particular event. So the calculated value refer to the normal distribution table values, or z score, what we call it as, because normal distribution, the formula is referred by a variable z, so the score is called as z score. So in under the z score, see whatever is the calculated value which is fitted in there, from that a table value is taken, and then table value is plotted on the normal distribution curve, and then we arrive at a solution after the value is plotted on the normal curve. Then moving forward, we have the next topic. What is the what is probability? How is it calculated? Probability of an event is calculated by, out of the total events, the ones which are favorable for a particular event happening. So total number of outcomes which constitute the event divided by total number of possible events, possible outcomes. So the favorable events divided by the total number of events. Let's say, for example, if a die is rolled, if the result what is expected is it should be an even number. How many values are there when a die is thrown? It could be 1, 2, 3, 4, 5, 6. So 6 outcomes are there totally. So there are 6 outcomes, out of which we want an even number. How many even numbers are there out of this total set of 6? 2, 4, and 6. So the favorable events are 3. So the probability of an even number appearing when a die is rolled is, we have it as 3 by 6 or equal to 1 by 2. What are features of probability? All lie between 0 and 1. So the sum total of all the probabilities is equal to 1. It lies between 0 and 1. Probability of an event is equal to favorable events by total events. Probability that it would not happen, it would not be a even number. So what, find out what is probability of an even number, that is 3 divided by 6. Subtract it from 1, because the total value of probability is equal to 1. Out of 1, subtract the probability of a particular event happening. So we can find out what is probability of the event not happening. So that can be calculated. What is risk and uncertainty? Risk is a situation where when there is a variation, the probability of a variation is also known, where we know the different possible outcomes and can estimate their associated probabilities. But in case of uncertainty, the possible outcomes are not known, or the probability of the variations or the outcome variations is also not known. Then that is called as uncertainty. Uncertainty is used when we do not know the possible outcomes and or their associated probabilities. Uncertainty is essentially a matter of ignorance. Okay, how do we calculate risk is, see, when the variation is given, along with the variation, the probability is also given. Then we multiply the variable into the probability, sum total of the variable into the probability is the value of expected value of risk. Expected value is a long run average. If an action has outcomes with associated probabilities, we have expected value is equal to sigma probability into the variable x. There is an example given. We have, these are the sales. Either sales can be 0 or 1 or 2. The chance that the sales would be 0 is 10%, which is 0.1, or 40% or 50%. So these are sales values, and the sale being 0 is the chance that the sale would be on 0 is 10%. The chance that the sale would be 1 is 40%. The chance that the sale would be 2 is 50%. So consider all of them, multiply into their respective probabilities, add it up. So we see the expected value of sale is 1.4, or if it is not sale, if we are talking about a risky event, we can call it as expected value of risk also. What is risk payoff? It is not that we always would have a particular variable with the variations, but there can be a payoff table, that is, it's not just one factor affecting but more than one factor affecting. In that case, the data is presented in a payoff table. So we see that, for example, payoff tables can be used in more complex scenarios. A store must decide how many items to order each day. Demand per day is 1, 2, or 3 with the following probabilities: that the demand is 1, probability is 20%, demand is 2, probability is 40%, demand is 3 again, probability is 40%. So uh, we need to prepare what are the payoff tables. So it's there are some other information also provided to us in the slide. It says that each item is bought for 10 and it is sold for 20. So while buying, they are buying the material with an intention to sell them. So each material at the time of buying it is only 10, but can be sold for 20. Unsold items, can they be carried forward as a closing stock, or they can be sold off? No, they just have to be destroyed or discarded at the end of each day. So let's say that they purchase the material, they keep it available, they purchase whatever is the stock, keep it available. And if the customers do not come to purchase that, it is a loss for them. Unsold stock is always a loss for them. But um, so how do we calculate what is the expected value? So I'll present this in the Excel sheet. So this is the content which is given there. So how do we calculate what is the expected value? There are situations where the demand is 1, 2, or 3 and the probabilities are given. Then in case where the orders are placed as 1, so one order is placed, demand is 1, they would be benefited. One order is placed, the demand is 2, they will be able to supply only 1. Okay, it goes on like that. So what do we do is, first we need to find out um, what is the profit which they can make is what has to be understood. Demand is 1, 2, 3. Then we have the probability. Probabilities are given as 0.2, then 0.4, and then 0.4. After that, we see the orders which are placed. When there is order placed for 1, only 1 is placed. See, demand is 1, so they will make a profit of 10. Because all what they have is only one order which is available with them. Order placed is they have acquired that material or that particular product, they have only one piece available with them. So when one piece is available, that is sold at 20. So sale price, I'm writing it here, selling price is, this is 20. What is cost price? 10. So how much is their profit? 10. So we see when order placed is 1, 2 or 3. So how much is profit? Profit when order placed is 1, 2 and 3. So if it is 1, only 1 is available with them. So 1 only will be sold. So profit in all situations is 10 only. Let's say 2 orders are placed. When 2 orders are placed, only demand is only 1. So they will sell 1. I'm putting the calculations here. When order placed is 1, what's the cost? The cost is 10. Profit they will when the order placed is 2 and demand is 1. So in that case, what is profit? They sell they sell one unit. Profit is equal to sale will take place because only demand is only for one unit into profit which is equal to 10. So they have 10 profit. They also purchased the cost is they purchased 2 items, 2 into 10. Sale value is not 10, sale value is 20. So do they have any profit or loss? So profit is equal to 0. Okay. Let's say when they have placed a when order placed is 2 only. If the demand is 2, if the demand is 2, see the sale of 2, demand is 2, order is also 2, 2 into 2 will be 40. What is the cost? 2 into 10, 20. So what is the profit? Profit would be 20 for them. When order placed is 2 and demand is 3. See, since they have placed only 2 things, so they would be able to sell 2 into 20, 40, but they have purchased 3. Cost is 20. profit is also again 20 only. So they have only 2 with them. On a similar note, we can also calculate it for when the order placed is 3. So I'm putting it here. When the order placed is for 3 units, and demand is 1. So sale will happen as 1 into 20. Cost will be 3 into 10. This is 30. So what do they have? They would have a loss of minus 10. Then here 2 are purchased 40, but because they have already there is a profit of 10.
Excuse me, ma'am. One doubt about the previous one.
Which one?
When the order placed is 2 and the demand is 3.
Order placed
Third one.
this one.
Third one, ma'am. This one. In the blue box, it is showing like 10, 20, 10, right?
Blue box is showing 10, 20, and
10.
10, 20, and 10. Demand is 3. Which is 2 into 20. Blue box. Expected value 0, 20, 20.
Ma'am, it's my mistake, I guess.
No, not your mistake. See, the calculation here it is correct.
Okay, okay.
Here it is correct, but here it is wrong. So it is 0, 20, and then 20. That's given when
It's in the
order is
vertical order.
placed.
Ma'am,
10,
it's in the
20.
vertical order, guys.
This way,
Vertical
vertical
order.
order. Yeah, vertical order, not a horizontal order. Vertical
Oh.
order. So minus 10, then plus 10, and here it would be cost is.
Ma'am, one small doubt.
Yes, yes.
Why there is the sale of only 3, 2, not 3 in the third one, previous one?
This one.
Yes.
They
And the
have with
demand.
them. They have with them only 2 pieces. Even
Okay,
if
okay.
customers want 3, they have only 2 with them. 2 pieces only are available, so they can sell only 2.
Okay.
So this is how the payoff table has to be prepared. So I don't think at this level it will be expected that you do that, but you learn it. Later on, at an advanced level, you see P1 is there. At that time, you will work out these type of questions. So that's how a payoff table is prepared and the values are calculated. So now take these values there to the table wherein profit when order is 1. In all situations, they have only 1 with them. So they would be selling only 1 and profit on each of them 10 will be earned. But when they place 2 orders, the profit which is earned is 0 or 20 or 20. Then the third one, minus 10 plus 10 and 3 into 20 is 60. Profit is 30. So values are minus 10 plus 10 and 30. Minus 10, 10 and 30. Now the point is we are not just calculating what is the amount of profit, but we have to calculate what is the expected value. So expected value of 1. Let's calculate that. What is expected value? Expected value of 1 is equal to, how is probability calculated? P into X. Probabilities are these and this is the variable X. So just multiply is equal to probability into the profit in the first scenario. Add it up. So this is expected value. So in all situations about expected value, we need to calculate it in the similar fashion. The expected value 2 is equal to the probability of 0.2 into the profit, which is 0, calculated for the other things, add it up. Then expected value of 3 is equal to probability into the profit when 3 orders are placed. Okay, so the expected values are, we see 10, 16 and 14. That's how the expected values are calculated. Let's get back to the presentation. I hope you understood the concept. Only you are left.
Yes, ma'am, understood. Hello?
Yeah. And I'm just going back to the presentation.
Okay. Okay, ma'am.
Yeah. Then we see that decision trees are also prepared to see when the decisions are not very simple. If we just, if it is not that we just choose from the alternatives available, but each alternative, if it opens up to multiple different alternatives, so in that case the decision is calculated by way of presenting it in the form of a tree. See, vertically the tree looks like this, wherein there is a stem. That stem opens up to branches again they split up into small branches, so it goes like that. So that's how a tree will look like. So we can also present the various alternatives available in the form of a tree. The only thing is the tree is not presented vertically, it is present horizontally. So it would be like this, it opens up into branches, etc. So such a scenario, um, all the alternatives are presented in this particular manner with their respective probabilities. So probability tree, or we also call it as decision tree. So probability trees use expected value but show the information in a diagram. For example, a company can invest in a new system which would cost 10,000. If this system could increase profit by 200,000 or reduce it by 100,000. So there are situations where they can go in for investing the amount to the extent of 10,000. So alternative is 10,000 investment, or they do not invest anything. Done. The system could increase profit by 200,000 or reduce it by 100,000. So this 10,000 can either result in increase in profit by 600,000, or the profit can reduce by 100,000. There is a 40% chance that the profit will increase. So the remaining percentage is 60% that it will not increase or it will reduce. Current profit at the present scenario. See, even in situation where they do not take up any additional investment also, their current profit is 400. So even if they do not invest anything also, they have a current profit of 400,000. So now after this, if they have a chance to further invest it, so they are considering it to invest it with 10,000. So this 10,000 is opening up to two different alternatives. That is, their 400,000 current profit can further increase by another 200,000. So profit will become 600,000. The chance of such a thing happening is 40%. Then there is also a possibility that the current profit will reduce by 100, so it can become 300,000. The chance of such a thing happening is, if one alternative is 40%, the balance of it is the other alternative, and only two alternatives are there. So 60% that the profit will reduce. Fine. So it says that should the investment be taken up? If that is the case, how do we work out? We work out now the tree is horizontally presented. So it's presented from left side to right side, but the solution has to be worked out from the right side to the left side. So the probability into the expected value is what we calculate. So these are two alternatives. Each of them have their respective probabilities. Multiply 600,000 into 0.4, 300,000 into 0.3. So that talks about the value here. If this is termed as A, if let's say that this is point A and this is point B. So at point A would be 600,000 into zero point 0.4, 300,000 into 0.6. Sum total of these two gives us what is the value at A. So value at A expected value of investment amount is this much. But this is a situation which arises only when they invest 10,000. So from the expected value, 10,000 has to be deducted. Okay. So the net profit from investment is 410,000. If they do not take up any investment, the current profit is 400,000. If they take up investment, they can be better off by another 10,000. So 410,000 will be their profit. So should it be taken up or not? It should be taken up, because the current profit of 400,000 will become 410,000. So it should be taken up. That's how decisions are arrived at. Did you learn all these things in your college? Did you learn these
Which one,
things?
ma'am?
Did you learn?
Which concept? This one.
Huh.
I think.
Okay, don't know. Okay. See, under probability, the next topic is what are joint probabilities. So joint probabilities are independent variables. Neither variable has any effect on the probability of the other. So they are independent. One event does not have an impact on the other event. So the probabilities are not dependent on the happening of the other events. Okay. But sometimes when we see that the probabilities are dependent on the other. See, joint probability of two independent variables A and B. Probability of A and B is equal to probability of A into probability of B. So and is given as a symbol intersection, or is given as a symbol union. Mathematics set theory, you must have learned that. So in there is an example given. A company has 60% probability of sales being 10,000 and 40% of sales being 6,000 in year one. If sales are high in year one, there is a 70% chance of sales of 12,000, and in year two, and 30% chance of sales of 8,000. If sales are low in year one, there is a 50% chance of sales of 7,000, 50% chance of sales of 5,000. So such a situation is tabulated. So in year one, sales, the only two different things are given. There is a 50% chance of sales of 7,000 and 50% chance of sales of 5,000. A company has 60% probability of sales being 10,000 and 40% of sales in 6,000 in year one. So year one details are given here. It is tabulated for year one. Done. Then proceeding further, if sales are high in year one, sales are high in year one. Okay. So that is this. If this is the situation, if sales are high in year one, year two sales would be, there is a 70% chance that sales of 12,000 in year two and 30% chance of sales of 8,000 in year two would happen. Okay. If 10,000 is what is the probability. So if for 10,000, these two situations can happen. But if the sales are low sales are 6,000. So if 6,000 happens, so these are the two different possibilities which can happen. So the probabilities are also mentioned. The joint probability is probability of A into probability of B. Probability of A is 60%, 60% into 70, 60% into 30. These are the probability percentages. So that's the joint probability. Then again coming to the low sales probability is 40%. So 40% into 0.5, 40% into 0.5. After we get that, so this multiply these two things, this is called as a joint probability. Dependent on the happening of event A. When event A happens, how would the event B be present? So the possibilities of event B, they are multiplied with the probability of event A. So we call this as joint probability. This model also you will learn in P1. Coming to the concept of cost volume profit analysis. So this is graphical presentation and also the mathematical equations. So first I'll explain to you the graph part of it. Once you understand that, the mathematical equations also I will explain. See, on a scale of activity outputs starting from 0 to the maximum capacity. In the initial class, we have learned about what is the cost classification, whether costs are the cost classification based on the behavior. The costs are either variable, fixed, or semi-variable. So broadly speaking, they are either in the form of variable or fixed. So a fixed cost is a cost which remains fixed and it is incurred right at the time when the output is 0 units. So 0 to maximum capacity, it is the same. So we see that there is fixed cost which is incurred, and it is incurred here, and it is the same until it reaches the maximum capacity. Fine. There's another cost which is variable in nature. Variable cost is a cost which varies proportionately with the output. As the output keeps increasing, we see that the variable cost also increases. So if we put it on the graph, it is not there. It looks like this, proportionate, no? So it varies proportionally. Done. The sum total of variable cost and fixed cost is total cost. See, at 0 number of units, already fixed cost is incurred. This is 0 number of units, already fixed cost is incurred. So the total cost, even at 0 number of units also, is at this level. So from here, as the number of units keep increasing, though fixed cost does not increase, since the variable cost is increasing, we see that the total cost is increasing. This green line is total cost. Then what about the revenue? At 0 number of units, no unit is produced, so no sales revenue. So sales will start from the origin and then it keeps increasing proportionately. as many number of units which are increased, which are sold, it keeps increasing. The revenue generated also keeps increasing. So the sales revenue keeps increasing. Done. We see that in the initial stage, the sales is below the total cost. So when is that profit can be earned? Sales minus total cost is profit. When sales is less than total cost, there would be loss. Fine. Until the point where both of them meet together. So this is the point where the total cost and the total sales, both of them are equal. Until that point, they have loss. Beyond that point, they have profit. Because after this point, we see that the sales revenue is overtaking the total cost. So beyond this point, we see profit is earned. This is the concept of graphical presentation of break-even point. So the point where both the points meet, that is the total sales and total cost meet or intersect on the x-axis when the line is extended. At this level, we see that this is the output, or these are the number of units of output at which it would break even. There is no profit, no loss. Both of them are equal, so there is no concept of a profit or loss. But below the break even point, there is loss, and above the break even point, there is profit. So the value when it is extended on the y axis, so this is the value of break even point. The same thing is presented in the next slides also. Um, So the next chart talks about the break-even point analysis. So because the fixed cost, so this is contribution break-even chart. The diagram is known as contribution break-even chart. The sales increases, the break-even point increases because the fixed cost does not increase. So this is the variable cost. This line is the variable cost here. What we see, this is variable cost. Okay, this parallel. Now this is the point of fixed cost. Fixed cost. No, not that one. Sorry. This is the fixed cost. See, it is starting from the total cost. That from this point, this is fixed cost. Okay, this is the variable cost. So here we see that the variable cost touches this point of this point. The see by the time both of them meet, we can say that is the break-even point. Here, the contribution break-even chart says that contribution can be read directly from the chart. Uh, what do we understand about that? So when an equation is presented about the contribution, the sales value minus the variable cost is called as the contribution. The contribution part of it also can be presented as contribution from the total contribution minus the fixed cost when it is deducted. This is called as the profit. So we see the sales revenue is there. The sales revenue is there. Then this is the variable cost. From the sales revenue, whatever is deducted, the entire part of it is contribution. From the contribution, when the fixed cost which is deducted, this will become the profit. So that is what is graphically presented. See, a contribution situation is when sales from the sales value, when the variable cost is deducted, this entire part of it is contribution, their margin, contribution margin. But fixed cost is only until here. Okay. When this fixed cost is deducted, so the balance of it is all profit margin. So that's presented in a contribution chart. After that, we see that initially there is a loss. The firm starts making only loss because there's no revenue, and the revenue gradually increases. But until it touches the total cost point, there is no scope of earning a profit. So at the point, there is no loss also. So at that point, there is no profit, no loss. Profit is zero. But once it crosses that, we see that there is profit. So that is in the positive quadrant. This is in the negative quadrant. So minus 10,000, it starts at a as low as a loss of 10,000, and then gradually it keeps increasing. At the point where it is zero, it is the break-even point. Okay. This is graphical presentation. Then um, the formula wise, when we look into that, there are a set of formulae. Time is not there that I can explain you the logic about what are these formulae. um, Contribution ratio, it talks about if sales margin, sales value is 100%, contribution margin is what percentage. So contribution into 100 by sales, so that is what we um, have the value calculated as. So the contribution by sales ratio is also known as the PV ratio. So the Indian version of textbooks, we see that PV ratio is the term which is very which is used, but the international material we see this term very specifically given as C by S ratio, contribution by sales ratio. Can also be calculated using total contribution and total sales value. Break-even point, see, the equation says that contribution minus fixed cost is equal to profit. Break-even point, there is no profit, no loss. I'm not explaining that in detail, but then try to understand what the logic is. The time is not there, therefore I cannot explain it in detail. So contribution minus fixed cost is equal to profit. But at break-even point, profit is equal to zero. Isn't it? This profit is zero. So which means that if fixed cost comes to the other side, contribution should be equal to fixed cost. So that is what is basically equated to find out what is break-even point in units and break-even point in sales. So contribution and fixed cost, both of them should be equal. Okay. So there's an example given. Very easy questions are included. It will be included in this particular topic. You can do them. Just have to substitute the values in the formula. The formula part of it, you have to be very clear. Any other sales value other than break-even point, there is either a loss or a profit. So the same equation, fixed cost by contribution, is adopted, but plus or minus profit or loss will be there. So that is the difference in the equation, and then we find out any other activity level other than the break-even point, so which can result in a profit or a loss happening. Then when is the business safe? Once it crosses, when the actual sales crosses the break-even point. Till the break-even point, profit is zero, but once it crosses the break-even point, they are safe. So the difference between the actual sales and the break-even sales is margin of safety. So that's graphically presented. So when the budgeted output exceeds the break-even output, that is the point where they are safe. That is the margin of safety. So graphically it is shown. Theoretically also, that is how we write budgeted sales minus break-even sales. So when it is converted into percentage, if margin of safety is 100, if budgeted sales is 100%, what is the percentage of margin of safety? So margin of safety by budgeted sales into 100 gives us margin of safety percentage. So there are certain assumptions which have to be looked into. Then we have a decision analysis, that is let's say that in case where resources are not abundantly available, there is a constraint, there is a limitation, limited factor, limiting factor, what we call it as. So if only a particular resource, if a particular resource is limited in availability, let's say that they have only one machine. So the time which is available on the machine has to be used, and all products have to be produced. Let's say two products are produced. So each product A, product B, both of them have to use these mesh nuts. So mesh nuts, only one mesh is there. Let's say 100 mesh nuts are available. Only 100 mesh nuts have to be used. So if that is the situation, how much contribution is earned is what is first calculated, because contribution is controllable profit. Variable cost is a controllable cost. Sales minus controllable cost is deducted. We see the controllable profit. So this controllable profit, how much is earned? So what is the controllable profit or contribution margin per unit of the limiting factor? So every 1 hour of measurement time used, how much contribution is generated is what is calculated. So then we have contribution per unit divided by the usage of the limiting factor. How many hours are required to make 1 unit of each product is taken. So we calculate it as contribution per unit of the limiting factor. So whichever product gives more amount of contribution by use of that limiting factor, that will be considered as the best profitable product, and resources will be allocated more to that particular product so that the overall profit can be maximized. Then in case of make or buy decision, so make or buy decision talks about, see when uh, when there are when products are produced, we see that in some of the products it is the um, assembling of many components. So these components are made, various components are made, and when they are assembled, we see that the final product is produced. Now, see when some of the components, see to make a very small component also, they have to invest a lot on the equipment, assets, resources, people have to be employed and all. So we have this decision only very specifically limited to the components, not the overall product. So is it feasible for them to make a component or buy the component from outside market? That's the decision which has to be considered. Let's say if they have to make, making is the criteria. If they have to make or if they have to buy. So to make the product, they have to incur variable cost. They also have to incur fixed cost. There would be no change in the fixed cost, and as many number of units are made, then that much of variable cost is incurred. Let's say if they are buying, they will not incur any variable cost. Okay, and what do they incur? They have to pay the supplier's price, the price which the supplier is extending, that price has to be paid. But can they get rid of fixed cost? Fixed cost is same from 0 to maximum units. See, whether they produce or they do not produce, they still have to incur fixed cost. So fixed cost would be incurred. So fixed cost becomes irrelevant. It is not relevant for decision making. So the decision is between, for making, what is the variable cost versus for buying, what is the supplier's price. So whichever price is cheaper, that will be the best option. If the variable cost is cheaper than the supplier's price, making is better. If the supplier is offering a price less than the variable cost, better to buy it from the outside supplier. Okay, so that is the decision in case of make or buy. So internal manufacturing cost, find out what is the variable production cost. But if it is bought from external resources, what is the price extended by the supplier? External bought in price. Okay. If external cost is cheaper, buy in. If internal cost is cheaper, make in the house. Internal cost is variable cost. External cost is supplier's price. See, need to use only the relevant cost. Relevant costs are variable cost and the supplier's price. Fixed cost is completely irrelevant because no matter what is the situation, it would still be incurred. So that's completely irrelevant. Okay, that is how the decisions are taken. I hope it is clear. Then now we come to the last topic, investment appraisal. Investment appraisal, what does it do? How is it calculated? See, there when the business activities have to be carried out, investment has to be made. Investment has to be made at the beginning so that the investment into assets or projects, they give returns in future. So there is some forecasting taken up and then estimate that This would be the situation and these would be the returns. So returns are anticipated. What are the profits or what are the cash flows are anticipated from the future. So even before the cash flows are earned, based on the estimations only, decisions have to be taken. So investment appraisal, whether the investment is worthwhile to be made or not is what has to be decided. So in such situation, whether the investment has to be made or not, there are techniques available under capital budgeting. So the first technique, see, there are techniques which talk about which are categorized as traditional techniques and uh, present value techniques or discounted techniques. Um, so under present value technique, we have uh, NPV IRR. Under traditional techniques, we have the payback period and ARR. Later on, payback period is also made it suitable for the discounted technique techniques or the present value techniques. So, what is the concept of about payback? See, if there is investment made as on today, today is always 0th year. So the returns will be earned 1 year from now. So at the end of 1 year, at the end of 2 years, at the end of 3 years. So if investment is made today, investment amount also has to be paid back in the form of returns. So all the returns when they are taken into consideration, let's take that the investment cost of a particular project is 1,000. So $1,000. The profits which are expected out of the investment proposal is every year 500 for the next 3 years. So year 1 500, year 2 500, year 3 500. So by the end of year 1 it is 500, by the end of year 2 it is 1000 is paid back. So what is the time period, payback period, what is the period in which the investment amount is paid back? So here in this example it is 2 years. So of course this is a very basic simple example, so we are able to calculate it, but then we see that it may not be uniform cash flows, they are different amounts spread over many years. So when we accumulate them, when we accumulate the cash flows, we may not get that round figure of 500 plus 500 is 1000. So partially it may be given. Then how do we calculate? So there is a formula which we use and then find out what is the payback period. The logic behind this is to understand what is the time period which is required for the investment to be paid back. Okay, what does it do? Consider how long the project takes to pay back the initial investment. Then how to calculate the cumulative cash flow and identify when the initial investment is recouped. Simple measures of risk, easy to understand, use cash flows. Then the payback period should always be before the time, because every project or asset has a time duration. If it is if the time period is life of the project is 3 years, the payback period should happen before 3 years. So there would be no returns after the life. In the fourth year, fifth year, there would be no returns. So the the logic behind accepting or rejecting is if the payback period is less than the life of the project, then accept it, otherwise reject it. Then payback period is a traditional technique, very simple, take it as at the face value. But there is a principle in economics which says that as the time passes by, the value of money decreases, the value is discounted, decreases. um, you must also have heard that elderly people, they talk about in our days we used to do so many things with 100 rupees or 1 rupee or something, they say now it is not possible. Why? Because the value of money has decreased. Okay, so when the value of money decreases, because if today the investment is made, out of this investment returns are expected in future at the end of 1 year, 2 years, 3 years, first year, second year, third year, so on. So will they have the same value what is anticipated? No, they will have a reduced value. Okay, that is the concept. See, as on today, if we have to find out there, that is a reduced value. How do we understand that? A basic example I will give you. Let's say that if a person has 100 rupees in today's time, if it is 100, that is 0. The prevailing interest rate, let's say the bank is paying an interest of 5%. Let's take for example. So at the end of first year, what will the investor have? He will have his own 100 plus a 5 rupees also will be added. So it is 105. 100 plus 5 is 105. So if someone has 105 1 year later, that is equal to having 100 today. So that's the discounted value. As the time passes by, the value decreases. So to compensate that, it is increased with the quantity. So 105 after 1 year is worth only 100 as on today. So the techniques about discounting the value of money, we call them as discounted techniques. So the time value of money also is one chapter wherein you learn about, see, the future cash flows. If we are finding out the value, we call it as discounting technique. But today's cash flow, if we want to find out after 1 year, after 2 years, so on. See, today's value will have 105 after 1 year, then higher than this in the second year, then it keeps on increasing. Today's value in future will have a higher value. Future value as on today will have a lesser value. So these are two techniques. So future cash flows, if we are finding out as on today, it's discounting. Today's values, if we are finding out for future period, then that's called as compounding technique. Interest gets compounded, it gets added up. So that's called as compounding technique. So how do we use that? There are formulae given, or we can also simply use the table values which are provided in the text material. So take them and then substitute and then find out that. Under discounting technique, we see that NPV, IRR, these are the things which are there. So only two techniques are there. What is NPV? So the set of cash flows which are given for the future period, they are discounted at the uh, discount rate. Discount rate would be mentioned. How do we take discount rate? Discount rate is basically the prevailing interest rate, or if that is not provided, the average cost of capital is also taken as the discount rate. So some discount rate would be mentioned at which we have to take all the future cash flows, discount them as on today's value, then consider what is the value. So after we discount the cash flows, add them up, sum total of all the future cash inflows after they are discounted, that is compared with how much investment is made as on today. So if the benefits which are earned from future are more than the investment made as on today, then benefits more than cost accepted, otherwise rejected. So that's the decision rule of NPV. So accept if the NPV is positive, that is the sum total of all the cash inflows minus the cash outflow. If that happens to be a positive figure, then accept the decision criteria, otherwise reject it. Okay. Then the last technique about IRR. IRR talks about, see, when the future cash flows are discounted. See, at what rate when they are discounted, the sum total of all the future cash flows is equal to the investment amount. That is the concept. So when the concept is presented in a equation format, discounting part goes in the denominator with an exponential. So it is not simple to substitute that equation. So what do we do is we go with um, trial and error method. So take two different rates and then calculate. Ensure that with one rate NPV is positive, with another rate NPV is negative. So after we have the NPV positive, NPV negative at two different rates, substitute the resultant figure of that NPV calculation in this interpolation formula. IRR is equal to lower rate. Between the two rates, one rate is lower rate plus NPV at the lower rate divided by NPV at the lower rate minus NPV at the higher rate into the difference in the rates. So when we substitute in this formula the value what we get is the IRR value. If IRR is greater than the company's cost of capital, accepted, otherwise it is rejected. Okay, so these are the topics what we have in our syllabus. That's the last topic. So now um, see when the discounting technique is used, so this is how they are calculated. So these are the formulae. Annuities are annually it is the same amount year after year. Perpetuity is forever it is the same. There is no end of that. Okay. So this is how the formula is used, discounting technique and all. That's it. So you're only the only soul, surviving soul. You tell me anything you want me to do, I will do it.
Ma'am, can we move on to some important problems like the in budgeting chapter and all one
You tell me.
problems are
See,
right?
you tell me any topic, I will take it from the exam kit and then we'll work it out. Because half an hour time is there, so we'll take it up. But you tell me about every topic in itself is important. It is not only done in here. Later on, also in other papers, also you will have to work out questions from that. So half an hour time is only
Um,
available. You tell me, I will take it up.
Ma'am, actually, I'm in third year. I was not able to write the paper in the first year, so I know about most of the concept, but the budgeting chapters, I forgot about the problems and all.
So you must have done a P1, no, by now because because you're in the third year. So you must have finished P1. You didn't do
Yes.
at that time P1.
No, ma'am. I kind of actually had chicken pox at that time, so I was not able to write it that
So you
vacation.
want to work out questions from fine.
Budgeting,
But
budgeting
just
or any other ma'am theory we can. I think we can. It's read and understood
uh-huh,
that. But
uh,
most of the
see,
problems.
theory you can study. There's no doubt about it. So the point is, which topic do you want me to work out the questions? That's the only thing what I am looking at because every topic in itself is an important one. So it will.
I think we have half an hour, right?
That's why you tell me your topic and then you said budgeting. I'm opening the examination kit. So from the
Okay.
exam kit, from budgeting,
One
it will.
from budgeting and one from other chapters, like 2 or 3 problems we
Budgeting
can
also there are
complete.
many budgeting questions. Um, okay. For your benefit, let me put it this way because you're saying that you want to um, write the exams. So um, you're from which college? Sorry,
Aloysius, ma'am.
Aloysius. Um, Aloysius, I have done P1 very recently. Hisham and all. So their recordings are there. Some other college extensive training was done for them. Many classes, more than 40 classes I have taken for P1. So all recordings are available. Uh, Now we will work
Ma'am,
on one question. I'll share the recordings with you. I'll give you the link where the recordings are there. It would be
okay,
there
ma'am.
on some resource. I'll let you know. Because Hisham also got some of the recordings. So whenever you have time, you listen to that, and then when you're preparing for the exams, I think that will help you a lot because every numerical question from P1 study text I have worked up. Every numerical question, so you can understand how extensively we've done that P1. So you can take it up and then do that.
Ma'am, what happened actually was I had that I told you, I had that chicken pox,
Yeah,
and
yeah.
1 month, May full month it was down. Then the second year started. Then I got a little bit scared. Like
Okay.
I got about the topic and the examination fees and all is very high, right? If we have to do it one shot, right? So I was then this then another coaching I took from the YouTube and all that was also not much effective for me. So I was waiting for someone for the coaching and all.
I'll you put your see you. I have your number. You also share your mail ID there. Um, some of them I have already sent to Hisham and others. So that also I'll forward it to you, and then see you can have that 40 hours of training. So before sleeping, every day 2 hours. If you listen to that 1 hour, you listen to that also you can learn. So every numerical question is done. So you can also choose which topic you want to learn, and that way also you can follow that. That is one
Yes,
alternative I'm just providing you. Okay.
yes, ma'am.
Let me just open the. Do you have to write this paper?
Yes, ma'am. I have willing to write this one paper. This is the first one, basic paper. This one,
Okay.
like diploma level paper. This one, BA2 paper.
Okay. Don't worry. See, these things keep happening that on account of health condition, sometimes you are not um, in a situation to write, but doesn't matter. You can still take it up and then um, finish it up.
Yes, ma'am. My some of my friends have passed in this one, so they also said that more weightage is from the budgeting chapter and all. It's not like every chapter is important, and the concept must be clear. But the problem seen while doing the online exam, we have to be faster, right? So I was that.
So even if you want to write BA2 also, follow P1, all the lectures of P1, because the same content is repeated there in P1 at an advanced
Even
level. So P1 training also will be over. You will be well versed with BA2, and then you can write the exam.
okay, ma'am. Okay, ma'am. I'll
Okay,
try that way.
that's a better way.
Like
Try
BA2
it
and
out.
ongoing learn the P1, learn P1 also together.
Together. It will be done in one go because the same topics, little advanced level. That's it.
Okay, okay. So that I will be thorough with it.
Ah,
Okay, ma'am. I'll do it that way.
I'll
I
see.
kind of look for that one. This one, the revision card and the textbook and all. My
That is
textbook is
a
actually
summary when you are thorough with the content. So that's just the summary
my
when
okay, okay. My textbook and all is in Mangalore itself. Uh,
study
so
text also. I think I shared it with you. No, did I?
no, ma'am.
Ah,
Yesterday I did not get.
and so I'll put now in your WhatsApp group both of them. You can take that.
Okay.
You said budgeting, no? So let's
Yes,
check.
budgeting.
See, it says that this planning and budgeting, the the next two questions, 71 and 72, are based on this information. This is budgeted figure, and these are actives. Budgeted activity is given at 10,000 units, but the actual took place at 9,500. So step number one is the budgeted 10,000 units will be first made as a revised budget at 9,500. All variable will be proportionately changed: direct labor, material, variable overhead. For 10,000, if it is 10,000, for 9,500, it becomes 9,500. If it is 5,000, then it will become For 10,000 units, if it is 5,000. For 9,500, how much? I think 4250 something will be there. Like that, we calculate, okay, variable cost. Then fixed cost will be any level, it will be the same. So 10,000 and then 5,000. So like that, we write variable cost varies proportionately. Fixed cost will remain the same within that relevant range. So when they are bringing it down to 9,500 also, it will not change. So that is what is basically. Then calculate the variable overhead variance for the month and state if it is adverse or favorable. So each value, now this is compared with the actual, and then we find out what is the difference. So this is a very basic question, but the methods of budget is what we will look into. So that's how it is calculated. I'll take you through the methods, the various budgets which are prepared. The same set of questions, EFG question is there. This is about cash budget, cash collection. Then very few are there. So this is about the cash budget. Question number 75. Which budget should I explain? Um, this is cash budget. How much does EFG expect to collect in January? I'll put this in an Excel file.
Yes, ma'am.
I hope you are able to see Excel.
Yes, ma'am.
EFG is preparing a cash budget for January. Its credit sales in the last 3 months were October, November, December. Some amounts are given. Estimated credit sales for January are 50,000. In recent debt collection experiences, see, they are selling it on credit basis is one thing. Plus, there are certain terms which are mentioned. That is, when the sale is made, 20% of the credit sale amount is collected in the same month. Let's say if they make the sale in January, the total sale value out of that 20% they will collect in the same month. Then 60% in the next month, 10% 1 month later, that is in the second month, and 10% will be bad debts. So that is how they would be collecting. That's the collection pattern. The question is asking. Then it says that a cash discount of 5% is taken for the payment in the month of sale. So whatever is collected in the month of sale, that 20% of them, they would pay only 95% of the value. That is, some cash discount is provided. How much EFG expects to collect in January? So if we say take January, see, if we are talking about the credit terms, I'm just writing it here. For example, let's say that the sale happened in January. So what is the collection pattern? A part of it in January, a part of it in February, and then a part of it will be collected in March. So the next 3 months, the amount will be collected. So 1 month January sale will be collected in January, February, March. Okay, so they're spread into the future. We don't want it. The question is asking us how much will they collect in January. So January sales they will collect. See, the previous months also they would be collecting. Let's say I'll put it this way. If January is here, we would see January's sales. If it is the month of January, the amount will be collected in January. Okay, then we see that It will be collected in February also, and then it will be collected in March also. So one January month sale will be collected in January, February, March. Like that, something which happened in the previous month, let's say December. So December, January, February, November, December, January, October, November, December. So October will not be affected here. So it will start from November. So when we look into that, November will be November, December, January. December will be December, January, February. January, February, March. So do you see that? That's the pattern in which they are collecting. So the amount, how much is it collected in the month of January? That is what is asked. So collection for a month, we have to look backward. In the previous months, the sale was made, but collection is made in the current month. That is what has to be looked into. How much is January sales? January has a sale of 50,000. So I'm just writing it here so that for your ease, 50,000 out of that 20% they will pay it in the same month. But will they pay all that? They will pay 5% less. So which means that they will pay only 95% of the amount. So the sale of January, what amount will be collected is equal to 50,000 into 20% into 95%. So this is related to January. The previous month is December. December, 20% will be collected in December. 60% of December sales will be collected in January. So sale is 100,000, 100,000 into 60%. Then we see previous month, November. So November 20% will be in November, 60% in December, 10% will be in January. So what are sales of November? Sales of November are 60,000. So 60,000 into 10%. Add them up. That will be the amount which is collected during the month of January. 75,500 is the total amount which is expected to be collected in January. Next, the next question is, a company is analyzing its overhead cost for the previous period and has produced the following. We have actual output, actual overheads, of which fixed overheads as budgeted is 87,000, adverse variance is 18,000. Um, this is variance analysis. What is calculate the budgeted variable cost per unit? So find out first what is instead of spending time on the some other budget we will work out. So that is standard costing part of it. So that's included here. This is purchases budget. The one which I have highlighted is purchases budget. The same set of questions are there in P1 also. So my advice, please follow that material. Question number 78 says that a company is preparing its budget for the next year. The following is available for the first 3 months. Production of each month is given. Raw material, opening stock and closing stock is given. Each unit requires 2 kgs of raw material. Raw material cost is $4 per kg. Calculate the raw material usage budget in kgs for February. So the policy about it is they have opening inventory and closing inventory. What is production? So let's first write the equation of production, not production, purchases. Purchases is equal to units required for production plus the closing stock of raw material, closing stock of raw material minus opening stock of raw material. Okay, production is given, then closing stock is given, then opening stock is also given. Fine. So very specifically they're asking only for the month of February. So just write February production. So production, um, the production units are given. These are in terms of units. Production is in terms of units, but the raw material is in terms of kgs. So let's see what is the production units. Production units is 3,800. Every single unit requires 2 kgs of raw material. So raw material required for production. So that is 3,800 into 2. So they require 7,600 kgs of raw material. Now to this add closing stock. Closing stock of February is 800. Add that. Okay. Then deduct opening stock. So less opening stock. So opening stock is 750. So this is material to be purchased. So we see 8,400 minus 750. So that is that many number of kgs of material is needed to be purchased during the month of February. I have helped you out to work high-low method, no? So you've learned about high-low method.
High-low method, I know, ma'am.
Okay, so we 82 is high-low method, so we'll not do that one.
Ma'am, this one also clear, and the previous one also.
Very few numericals are there in the exam kit.
Oh.
So follow my suggestion. You once for all you prepare for P1 only. So when you prepare for P1, I think it will give you a clarity about BA2 also. So college level exam also you can clear BA2, and then P1 also preparation will be done. Right? It says that a company is analyzing its overhead cost for the previous period and has produced the following. Actual output is given, actual overheads are given, of which fixed overhead is mentioned as 87,000, adverse variance is 18,000. Then the company calculates variances based on a flexible budget comparison. So the actual output is given at 162,500. We are asked to find out what is the budgeted variable cost per unit. How do we calculate what is budgeted variable cost per unit? Budgeted variable cost, total budgeted variable cost divided by the budgeted number of units, but that is not given here. All what we have is it's an adverse variance. It's an adverse variance of 18,000, which means that the actual cost was more than the budgeted cost by 18,000. Actual cost is 300,000, out of which fixed cost is 87. So variable budgeted cost, so 200 and some 13,000 would be the variable overhead cost. That variable overhead cost was 18,000 adverse. That part of it. So which means that actual cost was more than the budgeted cost by 18,000. Arrive at what is the budgeted overhead cost. Done. Um, let's quickly present this one. 76th question. Actual overhead is given as 300,000. From this, we see that of which fixed overhead, less fixed overhead, is 87,000. So this is variable cost. $213,000.
Ma'am, your audio is stuck, I guess.
Variable overhead variance, now it's given as the 18,000 variance. So which means to say that when the budgeted overhead minus the actual overhead variance, overhead amount, actual is more than the budgeted by how much? That is 18,000 adverse. Okay. So we see that actual variable cost is 230. Then what is budgeted overhead? So budgeted variable overhead is equal to actual variable overhead is 213. That is higher by 18,000. So we would be calculating as 213,000 minus 18,000. So that's the budgeted variable overhead. Budgeted variable overhead, we got it as 195,000. Done. Then the number of units. So it says that the company calculates variances based on a flexible budget comparison. Flexible budget comparison is both the actual quantity and the budgeted quantity, both of them would be same. So the actual quantity output is 162,500. So budgeted also it would be the same. We want to know what is budgeted variable cost per unit. So right, budgeted variable cost per unit is equal to 195,000 divided by 162,500. So check that how much is it. So that's 1.2 per unit. So budgeted variable cost per unit is equal to 1.2. So step by step, sequentially or logically, we have to proceed further. Okay. First, immediately take some of the lectures are there with Hisham. Ask him to send it to you. Take it from him. The rest of them, when I still have to send it to the students, and along with them, I'm also sending it to Hisham. I will also send it to you. Please share your mail ID with me, and then take the. So it doesn't happen overnight. That much at least you understand that the content is